Hello, members one and all of the Salivation Nation. I think most of us have probably wondered how some of these bullion dealers can, number one, either make a lot of money, considering the fluctuations in price for some of the precious metals that they hold in inventory or that they need to get in order to fulfill orders. And we also wonder how they are able to protect themselves in these massive market movements up or down. You know, we see deals on eBay from time to time when they sell there for gold at spot or very, very little above spot, and such narrow margins, it makes you wonder, number one, how they would protect themselves, or if they know something that we don't. And of course, I posted videos about that particular subject, and people have responded in both ways emphatically that they know what's going on, that they know the price is going to go down, so they're trying to get rid of their inventory so they can, you know, take advantage of that. Others say there's no correlation at all between the markets and what the dealers do with their promotions. But nonetheless, this little infographic from JM Bullion, I think, kind of helps explain some of it. How the largest precious metals dealers buy and sell millions of ounces of bullion each month. It's dealer hedging. Now, we understand hedging as far as what we do as holders of precious metals. We hedge against economic instability. We look at it as a firm foundation to protect ourselves and to preserve our wealth in times of economic uncertainty. Gold, silver, and platinum prices have been known to fluctuate significantly, which means dealers have to be careful that they're not on the wrong side of a big price swing. Hedging large bullion inventories is not the norm for all silver and gold retailers. Many local coin dealers and even online sellers do not fully hedge their positions. And we take a look at this infographic, shows some of the most volatile days. In recent history, we had between September 15th and 16th, silver dropped 23% from almost $40 an ounce to just over $30 an ounce. And in December 1st, 2014, silver jumped up 17% from intraday lows. And then on April 15th in 2014, gold fell more than $110 in one day. It's a pretty big move, precious metals markets. So over time, bullion dealers have developed a way to hedge against these market risks to make business safer and more predictable for both them and their customers. Then it goes on to define hedging, which is the process of playing both sides of a market to provide protection against the market's fluctuations. And really, that's really kind of a speak for you know, investors in a way, especially those wanting to protect themselves in the trading of gold and silver. But you think about that in terms of us holding gold or silver, you know, and I think that we're in a position for those of us who hold silver, especially because that's sort of the way that many of us went for many years after the financial crisis of 2000 between 2007 and 2008. You know, we saw silver jump up to like $48 an ounce, and now it's way less than half that. You know, we're flirting with $16 an ounce silver now. But you know what? It's a that just means it's hedging us because the economy is doing better. The dollar is stronger now, and as long as we hold our position, we are safe. And as long as we haven't cashed out from it, well, we haven't taken a loss yet. And that's why one thing that I know that I've talked about on this channel and encouraged everyone in these price dips to hold on to your precious metals, because you won't take a loss until you sell. And now there's times where people obviously have to sell, and that's unfortunate if they do take a loss, especially if they've bought at the highest of the highs at $48 an ounce. But most people haven't, to be honest with you. People have bought on the backside or the front side of that figure. So the bullion hedging means that the dealers has offset all of their long positions with short positions and vice versa, by ensuring that they never have a long or short overall position in the market. The dealer ensures that they're immune to market movements and lock in their margins between the purchase and premiums and sale premiums. And so let's take a look at what a long position is compared to a short position. A long position is when any inventory the bullion dealer holds or is priced ordered from a supplier. And then a short position of that would be any orders that the bullion dealer has yet to fulfill. And then the long position is a dealer benefits from upwards price movement. And then, so in other words, any inventory that the bullion dealer holds or is price ordered from a supplier, and they will benefit from the upwards price movement. So if somebody bought, if the dealer bought at $15 an ounce, and then they sell at $20 an ounce, they get that extra $5 margin. And then in a short position situation, we have the orders that a bullion has yet to fulfill. A dealer benefits from downward price movement. So that if a piece of silver sells for $20 an ounce, and the order ships out at $15 an ounce, that extra margin is where they benefit from downward price movement. That's called a short position. So the addition of those two together equals a net house position. The bullion dealer then trades future contracts to offset or hedge against a net house position. The standard futures contracts is about 100 ounce gold, 5,000 ounce silver, or 50 ounce platinum. So there you go. So that's how they do it. A sample situation would be a gold dealer holds 5,000 ounces of physical inventory bought at spot price of $1,200 an ounce wholesale premium. The dealer has 3,000 ounces worth of open customer orders sold at spot price of $1,200 plus retail premium. This leaves the dealer with a net long position of 2,000 ounces bought at $1,200 an ounce. So that if there's no hedge, that means that the net house position is long 2,000 ounces. So the long position is 5,000 ounces, and the short position is 3,000 ounces of orders to fill. The hedge means that the dealer would short 20 gold futures contracts for 100 ounces each for a total of 2,000 ounces. And so that the futures contracts balances out that 5,000 ounces there. So you have 3,000 ounces of the orders to fill and 2,000 ounces in future contracts to offset it. Without hedging, that would look like this for future gold price movements. Price increases $200 per ounce, then $1 million inventory gain, and then $600,000 worth of open orders loss equals a net gain of $400,000. If price decreases $200 per ounce, then it would be a $600,000 open orders gain and a $1 million inventory loss, which means that you've lost $400,000. With hedging, the things would look like this for future gold price movements. So the price increases $200 an ounce. It'd be $1 million inventory gain and a $600,000 open order loss with a $400,000 contract loss. So there's a $0 net. And then the same thing on the upside for the futures. So I think that's probably one reason why you're seeing a lot of this paper gold and silver so high, which means that there's obviously some manipulation going on there, especially for these bullion dealers, because the bullion dealers are purchasing these contracts to protect themselves. I think that's just one aspect of it, although with them doing it, it's probably less likely of a manipulation, but you never know. Tricks of the trade: since the markets are not open on weekends, online dealers typically estimate their weekend sales and take an offsetting long position into the closing bell on Friday with the hopes of selling exactly that much metal between closing Friday and opening Sunday evening. Some larger wholesalers will make weekend markets with widened spreads to allow dealers to buy and sell metal on the weekend as needed. The market maker in the scenario takes additional price exposure into the Sunday open. in exchange for the widened spreads throughout the weekend. And then so the question is to hedge or not to hedge. Dealers hedge to ensure that even if spot plunges very quickly, they're still financially stable and secure. Dealers who do not hedge or are not big enough to trade future contracts run the risk of being wiped out by big and anticipated market movements. So, there's a risk for some of the smaller dealers for sure, but that hedging does protect, and so that's how these long and short positions with these contracts, future contracts, protect these larger dealers. And I assume that JM Bullion, probably Provident Metals does it, Gainesville, APMEX, and others. And I think that's part and parcel why, to some extent, we can see some of these dealers offer their deals at very little over spot from time to time. And because they may have the surplus inventory that they want to get rid of, and they feel emboldened to be able to do that because they're still going to make money on it with these contracts. So quite an interesting infographic, pretty detailed here, and how these positions hold out and how they hedge to protect themselves. And in some cases, it could benefit us, the buyer. So post your thoughts below. I'd like to extend the multitude of gratitude y'all for watching and encourage you to please rate, comment, and subscribe.